Hello, my name is Greg Reed. I'm the president of Real Assets, and I'm here to give you an update on the energy infrastructure performance for March and year-to-date 2023. In terms of the first month of March, basically things were fairly flat. The Alerian Midstream Index was down about 0.1%. Looking at year-to-date, overall, we had an 0.8% positive return for the Alerian Midstream performance. The Alerian MLP segment of that was actually a lot better, up 4.1%. But I think the real picture is that we started off the year pretty strong with a 5 to 8% return in midstream and MLPs, and then we had about a 6 to 8% correction mid-month. And so went up and then came back down, and we bounced back here at the end of the quarter. Basically, what happened was we had a fairly decent correction in crude oil prices. They finished down for the year-to-date period 5.7%, but they did fall at one point about 13% intra-quarter. And more importantly, natural gas prices fell about 50% in the first quarter. Thankfully, there's not much correlation between natural gas prices and midstream. As you can see, we had positive returns in midstream, but we did see natural gas fall 50% and LNG fall 35 to 50%. That was really a function of the growth in supply and the warmer than normal winter in Europe. Many people were prepared for a normal colder winter, which could have led to a shortage with the Russian attack in Ukraine, and thankfully it did not happen. So looking at the month of March, we took a look and we showed that the average C Corp was down about 2.4%. The MLP average was down about 1.5%, and the Canadian C Corp average was down about 1.6%. So it was a down month for March. The more important numbers are the year-to-date period, and the averages actually are a little misleading. The average C Corp was down 5%, but the weighted average, market cap weighted average, was actually about flat. Some of our holdings in Plains and LNG were up 5 to 7%, but there were some stocks that were down double digits like E-Train as well. On the MLP average, it was actually a lot better. The average MLP was up 4.2% for the quarter, led by Genesis up about 12%. And the largest loser was Cheniere's MLP CQP, down about 15%. So why was that? That was really a function of lower gas prices and rising interest rates that impacted that stock more than others. Then on the Canadian side, which were significantly underweight in our portfolios, the average stock was down about 2.2%. Only one Canadian company was up for the quarter. Key Energy was up 1.6%, with most of them down 3 to 6% for the quarter. So looking at one of the big things that happened in the first part of the year was the OPEC decision to cut production by 1.15 million barrels. That came right after the end of the quarter on April 2nd. That really was a strong sign that OPEC wants to maintain healthy oil prices. To us, that means prices somewhere in the 80s as opposed to the 60s that they dropped down to in March. We think that's overall good news for our industry in that it props up oil prices and allows U.S. producers to grow production, which benefits midstream pipelines with higher production levels. So at the end of the day, having a higher commodity price is good for our space. The other thing that's pretty surprising on slide 5 is that the commitment on from traders to the space has actually reached an all-time low. We think what's happened is last year's Russian attack in Ukraine brought in a lot of speculators. Many of them have exited the business now and have kind of unwound positions. And we have fewer open contracts now, which is probably a good thing. There's less speculation going on in the market from traders and are more fundamental investors and hedgers in the market today. Looking at the valuation slide on page 6, we can note that the multiples expanded during the Russian attack in Ukraine. We saw our industry go up to about a 10.5 times EV to EBITDA multiple. Why was that? That was really due to oil prices going up as high as 130 last year. They've subsequently fallen back to a level of about 65, and they're now around $81 here in U.S. crude. And so what's really interesting to me is while the valuations are a little lower, about 9.3 times EBITDA, we managed to produce a strong 20% return last year in our space, despite valuations getting 7% worse. So that, I think, is a function of attractive valuations and high free cash flow, which is being returned to investors. So in terms of some of the key metrics we look at, we of course look at valuations we talked about. Looking at kind of price charts, we see that the AM&A index has really found itself in a trading range. Lower support levels around 460 that we saw in March have been pretty strong support. On the high end, we've been as high as about 560. And so after a decent rebound here in April, we're about 505. So we're right in the middle of the trading range right now in the AM&A. Our view is when things get oversold, when the relative strength index is down at the low end of the range, it's a good time to add to positions. And if we find ourselves back up at the high end of the range, not a bad time to trim and take some profits on these stocks. In terms of the consensus outlook right now, it's actually quite positive. The average dividend yield is about 6% today. And the street consensus from third-party analysts is that these companies have about 24.5% next 12-month return potential, which looks quite good. Part of that's a function that the last 12-month returns have been flat at about minus 0.7% through March 31st. So while we haven't made a lot of money, we have weathered through a storm where oil prices peaked at 130, went all the way down to 65, and are now at 81. So despite all that oil price volatility, investors are about flat, which is frankly a lot better than the S&P 500 over the past 12 months. And then wrapping up with our themes, we remain optimistic on outperformance from energy infrastructure. The reason is that these companies are generating record amounts of free cash flow. And we think that low valuations and increasing free cash flow is really what is likely to drive returns higher. We do see continued strong global demand for US LNG, and these low natural gas prices should drive continued growth in LNG exports from US producers to Europe and to Asia. We do think that crude oil is poised to grow over the next 3 years. We've been expecting about 500,000 barrels of growth for the next 3 years. A couple of weeks ago, Enterprise Products, a big MLP in Houston, had their annual meeting, and they came out and said they see about 1.8 million barrels of growth over the next 3 years, which is about 600,000 barrels a year. The good news is everyone's generally kind of circling around 500,000 barrels of growth, and our space earns more EBITDA and revenues from volume growth. So that looks like a very positive feature of our space. So when you kind of back away and say it looks like our space is poised to provide attractive returns, that's based on free cash flow being paid to shareholders. That comes through a 6% dividend growth, deleveraging, of course, and some share buybacks. So that is the recap for the first quarter. I appreciate you tuning in, and we hope you find this helpful as you evaluate your investment in this sector. And if you'd like to get a copy of the slides or have a call to talk about our outlook for the year, feel free to reach out to your Westwood representative. Thanks a lot and have a great day.